We are live, my friend.
We're live.
All right, so welcome to Money Mondays, everybody, with your host, Ferris and Ben. I'm the handsome one, he's the bald one, and we're testing out some new functionality. But Money Mondays, basically, for those of you tuning in for the first time, we basically try to, we're hosting this every Monday, 3:30 Central. And what is our goal with these, Ben? Maybe kind of quickly run people through.
We're trying to add some value to folks, right? Trying to educate some folks. In the 20, 30 minutes that we have, right? You're not going to learn everything about the business, right? But, we're just trying to kind of, especially on an afternoon, on a Monday afternoon, try to give you a little bit of content. It's not necessarily going to all be about multifamily either, right? We do multifamily disrupt equity. That's kind of our shtick, right? But this is going to be about being an entrepreneur, about hacks and productivity, to tax advantages of different commercial asset classes to maybe other asset classes, right? So we're really wanting to encourage the interactivity of the show. So shoot us a DM with any kind of suggestions that you might have on the show.
Yeah,
right?
We want people to ask questions. We will answer your questions live. Anything you want to ask. For those of you that are tuning in for the first time, I usually want someone to ask, how did Ben lose his hair? Which deal? We'll tell you which deal. Similarly, I'm starting to lose it as well. We're obviously very busy, but really,
5 more years.
We're kind of open Q&A, right? Happy to talk through any topics people want to talk about. Whether how to find your first deal, how to finance your first deal, how to sell a deal, how to operate a deal. I mean, we're trying to go through all the different topics. But
yeah, we host a lot of events, and the best part of our events, for us included, right, is the Q&A.
Yeah.
Right, because we're learning things alongside you guys. People look at things differently. So really, and if you don't, you can DM us offline, and we can kind of obviously incorporate it into our next show.
For those of you not as slick on the terminology, DM, direct message.
There you go.
All right.
There you go.
What's our topic today, Ben?
So we're going to talk about how do investors use a self-directed IRA to the benefit of investing in real estate, right?
Yeah.
And you can use your self-directed IRA to invest in a lot of things, right? But we're going to focus on real estate today because that's kind of our background, right? And what are the benefits of that, right? So I guess let's start off, Ferris, man. Tell everybody in the most simplistic way, right? What is a self-directed IRA?
Yeah, so for people that don't know what an IRA is, let's start with IRA, right? It stands for, what is it? It's an individual retirement account,
yes,
I believe, right? Now, really for people that have jobs, right, a lot of times their company will provide an IRA, right? And they basically, they may be funding some of it personally, some of it is funded by the company. But the important thing is that an IRA is kind of a defined thing by the federal government, right? It's essentially a retirement account. It's almost a forced retirement account, right? Where money gets parked off and you can't access that unless certain conditions are met.
It's tax deferred,
yes,
right?
And so the trick is that it's tax deferred, right? And it lets you continue to build wealth, right? Not worrying about the tax consequences, right, at the time. But what's maybe powerful and unpowerful is that forced retirement piece, right? Meaning that you can't tap into that money unless a couple of different things, right? Usually it's, you have to meet a certain age threshold.
It's 59 and a half.
Yeah, and then there's some other restrictions as well, or some other chances too, right? If something happens life-threatening. I know with COVID, they've allowed people to kind of access it, but we're not really going to go into an IRA details of why an IRA, but let's talk about the self-directed part. Now, usually 99% of people, I don't know the exact stat, most people use their IRA to put in the stock market because that's all they know how to do. That's all they know they can do.
Their IRA custodians might be, that's all you get, right? You get maybe a bucket of stocks.
Actually, you mentioned a good point. What is an IRA custodian?
So these are people that are going to be like a steward of the actual IRA money that's coming in, right? They're going to set up the account. They're going to administer any questions, cut checks as needed.
It's kind of like, in a closing process, it's kind of like the title company.
Yeah.
They're holding the money. Yep. They're doing all of the legal paperwork.
They're a neutral third party, right? And in some cases, right, they'll direct money into certain stocks, bonds, what have you, right? And bigger corporate type IRA accounts, right? So whenever you have self-directed, so what's the difference between a self-directed and that?
Yeah, so the self-directed piece is actually where it's really powerful, right? It's that you find a certain, not any custodian can do it, right? You need to find a custodian that can do the self-directed piece, and it lets you put your money into something that you are self-directing, meaning you can say you want to put it in stocks, but really in our world, we're talking about real estate, right? A lot of times. It's that me as the person that owns the retirement account, I can say I want to put $100,000 into this investment opportunity or to this investment opportunity. And there's a couple of gotchas, right? I think there has to be a separation between me and the ownership. So for example, I can't invest my IRA into a entity that I own or I'm a managing member, right? It needs to go into something that I'm kind of it's a neutral person, right? Because again, they're trying to make sure you keep separation. You're not using your money kind of behind the scenes, right? And there's some other rules, and we're not going to go into the specifics of that, but the most important thing is that I can decide to invest in deals, right? A lot of times, there's a lot of the kind of people really start with a self-directed IRA as kind of private lending. Right, they're lending their money to a flipper.
Yeah, that's what I was going to say. So a single family, right? You know, I mean, and that's really where we I think we both kind of got involved with the IRA companies is really the single family side, right? There's a lot of these guys that, especially flippers and people that are, maybe looking to do, owner financing, right? They go out, they buy the property outright, then they owner finance it back, right? So there's a lot of ways that you can use it, right? IRAs are great because, not only is it single family, but you can do multifamily, you can do precious metals, you can do pretty much anything from the self-directed. There's a couple caveats to that, right? But that is the whole point of it being self-directed. You're allowed to go out and do certain things as long as you have some guidelines there, but it gives you a lot more flexibility than getting to pick from 2 buckets of stocks to go and invest in, right?
And so it's a good vehicle, right? So again, but most importantly in our world, you can syndicate with it, right? So you can invest as a passive investor in a deal that is being syndicated. And that's where it becomes, even more appealing for at least what we do, right? And so really kind of, I think we go through some of the questions that we have, right? So what is self-directed IRA? I think we mentioned that one, right? So the benefits of using self-directed IRA, right?
I think the biggest benefit is that you have some control over it, right? You can, once again, it gets you away from picking 2 buckets of stocks to put your money in, right? And you can go out and invest in real estate deals or some other business, right? Or a house.
And because you're using your self-directed IRA, right, you still get the benefits of the IRA piece, right? That money is staying within that IRA account.
And I wanted to kind of mention a couple different things, right? Once again, your IRA custodian is really helping you muster through this whole entire process, right? Like, it's not going to be like, hey, you're just going to cut a check and this is how this all works. They're doing that all on your behalf because there has to be a third party that's administering it, right? Otherwise, you will be in jeopardy of blowing up the IRA, and then you have those tax advantages go away. The fees and penalties can kick in. So that's a big thing that I wanted to mention. The other thing too that Ferris kind of mentioned too, especially on the syndication side when we're talking about multifamily, right? You cannot use your own IRA to invest in your own deal, right? So you have to invest in somebody else's deal as a passive investor, right?
And we have other sponsors that we know that have invested in our deals for that exact reason, right?
They're trying to deploy a certain amount of capital each year, right? And so, they'll come along and they'll invest through their IRAs, right? But the other thing too is that, say your son or your daughter is the one that's putting the deal together. They're the sponsor, right? You can't use your IRA money to invest in their project either because you're related. So there's definitely some rules around it. And once again, I'd suggest you guys talk to some IRA custodians about those different rules. We're not experts on it. And we'll give you guys some folks that we like, right? But those are just some things that I wanted people to kind of talk about prior to really kind of getting into the benefit, really, which is, once again, you have control over your own retirement account, which is great, right? In this day and age, right? So, getting to those IRA custodians.
Yeah, so really, where can you set it up, right? I think the 2 that we like, we've worked with, we kind of trust, know is, kind of one of them's Quest IRA, they're local, as well as Advanta IRA, right? From the sponsor side, we've worked with both companies. They do a good job because, from the passive investor side, right, it's the IRA, all it solves is the sourcing money problem, right? It's where the money comes from. You're still passive. You're not having to get more involved or less involved, except, right, each year, you have to kind of go, there's a form that you need to fill out that you're basically saying what the valuation of that investment has become. And, that's where we get to work with these different entities throughout the deal, right? We work with them up front to kind of help provide the paperwork, the PPMs, getting all the signatures right. And then, from that, you're just doing that once a year paperwork, and that's about it.
And sometimes, just from that one interaction, right, sometimes it can be a challenge, right? We've also seen when you're closing the deal, so we're looking at it in the lens of a sponsor, right? You do have to interact with the IRA sometimes. They might want to have some paperwork, whether it be the PPM or they might need you to sign a certain way. There's sometimes, depending on who the IRA custodian is, there might be an extra level of paperwork that the sponsor has to do just up front before they'll actually fund the deal from this IRA's account. So I want people to understand that too, right? But all that level of pain, both on the sponsorship side as well as on the investor side, right? People realize that, and then they start kind of gravitating towards these firms that we tend to like to do business with because they make it easy on people.
No, absolutely.
Right?
So if anyone has questions about these firms, feel free to reach out to us. We're happy to kind of talk through it. But before we keep going, right, for those of you tuning in, Mondays, we try to host this, every Monday, 3:30 p.m., right? Come rain, snow, sleet, or hell. We don't really get much snow here in Houston.
Snow, it's like 112 here. But
our goal of this really every Monday, going through different topics, right? Really doing a big breadth of topics. And this week, obviously, we're talking about self-directed IRAs. But the more important the value piece, at least for us, is that live Q&A at the end. Feel free to ask questions. List down anything that you guys want to know. It doesn't have to be about self-directed IRAs. We're happy to talk to them. So, David, nice seeing you again, man. You're definitely one of our biggest supporters out there, so appreciate that.
Thank you.
Savion, let's go. We're going to go. And then Jan, how are you doing? Long time no see. She's saying talk about UBIT.
Well, we're getting to it. We're getting to it. So that's
maybe
I guess
let's just talk about UBIT.
I'll flip to our. So this was one of the questions, which is, what are some of the risks of an IRA or investing through an IRA that we have seen, right? And UBIT is one of them, right?
And I think UBIT stands for Unrelated Business Income Tax.
Yes, and we're not going to get into the weeds here, folks.
Yeah, please talk to your CPA. Maybe a quick disclaimer. Anything we're talking about, we're giving just our experiences.
Yes.
Please don't make big, important life decisions about it unless...
Go talk to a financial professional. Go talk to an IRA custodian because they're going to be able to answer these a lot better. But it essentially has to do with the fact that on a lot of these real estate deals, especially syndications, there's going to be a mortgage involved, right? And that triggers what's called this UBIT, right? So, and it's not, don't think of it as in terms of thousands and thousands of dollars, but I mean, it could be a couple $100, right? And so people get this tax, and it's supposed to be a tax deferred account, and they're like, what's happening? So over the last 3 to 5 years, people have started kind of uncovering that it's not 100% tax free or tax deferred on at least some of these investments. So you need to be aware of that, right? But still a lot of advantages. I'd say that's probably the biggest one, as well as, once again, another risk or another downside of investing in the IRA is, once again, you don't have full 100% control, right? You can't invest with your family and friends. There's certain things that you're not going to be able to invest in, right? But for the most part, compared to a traditional IRA or 401k that your company might have set up or the corporation that you're working for, way more flexible. So, I mean, if you can roll it into that, I'd encourage you to do it as quickly as you can, because it's going to open up a whole nother layer of investments that you can take advantage of.
Absolutely.
Right? So, tax advantages. These are questions that we had kind of gotten beforehand, and we kind of already went over this, but we'll go ahead and reiterate it because this is a big thing. Tax advantages your investors utilize with a self-directed IRA, right? It's tax deferred.
Tax deferred. I mean, it's almost self-explanatory, right? No point in being a self-directed IRA without it.
You would know, yeah. So you can maybe open it up when you're 30. You're just chewing money all the way through it, investing. 59 and a half. You can start taking out that money that you've accumulated in that account, which is going to be a lot more than probably just playing the stock market, right? Because if you get into some of these syndications, you get into some of these real estate deals, you're going to be able to balloon that money pretty quickly, right?
Yeah, and maybe one other note, we didn't really talk about this, but you can pay a penalty to take your money out of a self-directed IRA. So there's a big, maybe debate about, does it make sense or not, right? And go research it, just know that it's an option, right? And again, you got to figure out, do the tax benefits outweigh the costs or not, right? To kind of do each one.
Because you got to look at it like this, right? You're going to have a fee, you're going to have some penalties, right? But if you take it out and you have 100% control over your money now, right? Can you grow your money even more quickly, having taken into account those fees and penalties? And once again, that's kind of the debate that we've heard, right? And we are not here to make life decisions for everybody, so you have to really crunch the numbers on your own. But it's something to think about too, right? But if you say, hey, that's way too risky, I just want to roll it up there, and then that forces you, like Ferris had mentioned earlier, it's a forced retirement plan, right? You got to keep it in there. You can't take it out and go buy that boat or, buy a second home on the beach, right? You're forcing yourself to invest in it the whole time, right? That can accumulate a lot of money at the end of the day. Yeah. So.
Awesome. So for those tuning in, right, Money Mondays, do it every Monday, 3:30 p.m. We try to go for about 30 minutes or so. And, we go through different topics, right? But our goal is really live Q&A. So please feel free to ask questions. It doesn't have to be about today's topics, about anything you want, right? We're going to crack some jokes. But Maybe not, but our director over there was sleeping on the wheel, but it's all
Oh shit! Come on.
But
no, she's doing a great job.
So let's see. So people have questions, definitely ask them. We're going to go through them now, right? Any other topics before we start going to questions? So if you have questions, please feel free to ask them. I see a few coming through already.
Yeah, let's go ahead and go with it.
All right. So Jan says, can't wait to roll my 401k into a self-directed IRA. Yeah, that's another thing. We didn't really mention that, but you can roll 401k into self-directed IRA. There's some gotchas there too. If you want to know how to do it, talk to Jan. Clearly, she's the expert. I haven't done it personally, but it is a vehicle, right? And again, each of these things, there's a lot of different vehicles out there. There's even EQRP. We haven't really talked about, which is really another flavor of it. It's kind of the same thing, but get educated. I think most people. No,
absolutely. And call Quest, right? And call these firms that we talked about, right? Because they're going to be able to tell you what you can and can't do, depending on where you're at, right? Like, there might be some restriction at your company, right, that you can't roll your 401k over, right? Yeah. You might only have a certain amount of control over it after you've left. Yep. Right, so you just need to be aware of that. So,
I've heard of people trying to leave so they can get control and coming back or things like that.
You have to be careful. So they're going to be able to kind of look at what you're currently in and what you're trying to do and say, okay, is this possible? And if so, this is the way that you're going to do it, right? And don't get us wrong, folks. These people do not work for free. There are some fees involved.
That's a good segue to the next question. So our friend David asked, can you post the 2 self-directed IRAs you work well with? Do you know how many basis points they cost per year? Right, and so the 2 that we mentioned, Quest IRA and Advanta IRA, right, we'll post the link to them. I'll type them in here now.
Yeah, so I haven't seen anybody charge basis points, right? It's usually based on transactions, right? Like the amount of things that you have to do. Now, there might be a flat fee, too.
I think there's usually
there could be a flat fee.
I think there's a flat, servicing fee for just the balance, right?
Okay.
But David, I would recommend just talking to them. We don't know.
Yeah, and it could have changed, right? They could be being more competitive now that COVID and transaction costs, or transaction volume has gone down, right? Maybe they're trying to be a little bit more competitive with their fees. I don't know, but there's definitely these guys are not free, right? And that's obviously something
everyone
you have to balance
needs to make money. For those of you new to the business world, realize it's not about no one making money. Everyone makes a piece of the pie. Right, but it's kind of understanding that, but it's obviously you're making a lot. This is a big
thing, and this is my own personal opinion. I'm not even going to speak for Ferris, right? I would pay up to an extent, right? There's always an extent to have the flexibility and the customer service of a good firm, right? Yeah. So you take that into consideration. Sometimes you get what you pay for too. So if you want to get that low fixed rate IRA custodian that out of wherever, Topeka, Kansas, right? I'm always picking on Topeka. But, you're probably going to get what you pay for, right? Whereas if you step up and you get a little bit better firm, you're probably going to get the customer service and the hand-holding and the asking of questions that you probably want, right?
Ben likes his hand-holding. So.
I do. No, I mean, when we're talking about a lot of money, right? Like, I want to be able to pick up the phone and talk to somebody, right? If I've got a question on how I want to do something, like, I'm not going to punch out an email and wait 72 hours for somebody to respond to me. I want to have a phone number. I want to call somebody. I want to ask questions.
Yeah, and it's important, right? Again, you get what you pay for.
This is your retirement account.
Yeah.
This is what you're going to retire on. This is your lifeblood.
Which is actually a good segue to the next question, which is self-directed IRA risks you guys have seen. I think the risk is understand the sponsors you're working with, right? Get out there, get educated about what you're investing in. Don't invest in multifamily because you think it's cool.
Yeah,
get educated. Go out there. We launched investoracademy.net. It's kind of a source to get educated. There's a lot of other options out there, but go get educated about what it is you're investing in, how it works, right? Mm-hmm. Self-directed is just a piece of that. And then lastly but not least is part of getting educated about what you're investing in. It's understanding who you're investing with, right? This is a marriage, really. It's a long-term relationship, right? 5 to 7 years. I mean, I think that's more than the average way marriage lasts, right? So understand that, and I think so. What's the stat for the average?
That just seems really.
I'm going to look it up for you.
That seems very short.
Average.
I'm hoping it's longer than that, but
length.
No, but I mean that's risk in any investment, folks.
National
right?
length of marriage in the United States is about 8.2 years.
All right, so you're still
almost,
off. You're
off by a year.
You're off.
Ben is happy because the occasional time I'm wrong, he likes to rub my face.
You're right though, and in a way, you have to do your due diligence on anything that you invest in, right? Regardless if it's through a self-directed IRA or it's your own cash in the bank, right? So there's risks in investments in general, right? The biggest risk that I always tell people when they get into multifamily syndication or any kind of investment, right, is you have the possibility of losing every single one of your dollars, right? You know, your whole cost basis could get wiped out because these things are risky, right? Now, that doesn't mean that yet you can also double your money or triple your money in some cases, which we've been able to do for some of our investors. So take that into consideration. That's the biggest risk. But I'd also say the U-bit is another risk. And then also just incurring fees, right? If you're one of those people that's really going to ramp this up and invest in a lot of stuff, you're probably going to pay for that a little bit too, right? In terms of fees. So that'd be another risk, I'd say.
Absolutely. So for those tuning in, we're nearing the finish line, but you know, Money Mondays every Monday, 3:30 Central, going through different topics and answering questions live. So please list your questions. We'll go through any more questions you guys want to talk about. Why is the sky blue? Why is Ben's shirt blue? Why is my shirt blue? Why do we like blue so much? Our logo's blue. We like blue in this company.
I do like blue.
And so we're happy to talk about whatever you guys want to talk about. So if you have questions, definitely go ahead and dump them in the questions, or you know, we're going to wrap it up probably a little early today.
Oh.
Anything else going on?
Yeah, this was kind of a short topic. They don't always have to be 30 minutes, right? You know, I mean, I think that this is stuff that you need to go do some research on because each person's retirement, you know, is different, right? You know, and what works for you and your family. You just need to get comfortable with those different firms, right? And we put some suggestions in there for people too.
Absolutely.
And so, you know, but we want to encourage people, reach out to us. If there's a topic that you want us to cover, we're definitely willing to cover it, right? And it does not have to be multifamily, does not necessarily have to be real estate, right? You know, we're all out here learning and trying to get better and, you know, just be better investors in general.
I have one question that's probably we didn't talk about. That's probably important. Explain, where does the money go whenever you pay distribution? Does it go to the individual or do it go to their IRA?
Actually, wow, you just brought up, this is actually one thing that we didn't really cover too, because we also do cost segregation.
Wait, say that again, wow, for me, right? For my comments, right?
So the money does get distributed back into the IRA account, right? And that's usually...
so if you're investing a self-directed IRA and money hits your personal bank account,
that's problem.
Sponsor made a mistake. You got to get that fixed.
That's problem, right? You know, you don't want to blow up your IRA. So that's going to go back into the tax deferred account. You cannot touch it. It's not going to be like, oh, I get my money, right? You know, so that goes back there. The other thing that I wanted to point out too that we totally forgot to mention was cost segregation, right? You know, you usually are able to get that in the first year, 2 or 3, you know, as a loss, right? That will help with your taxes if you invest as, you know, kind of a cash investor, right? Outside of the IRA channel. Well, that doesn't really work as well when you already have a tax advantaged, you know, channel that you're investing in too. So take that into consideration. That's not going to be as big of a benefit or a benefit at all, you know, for you, especially when a sponsor talks about cost segregation and you're going to be able to write off 40, 50, 60% of your investment in year 1, 2, or 3, right? That's not going to really matter to you, right? You're already getting the tax advantage of the IRA. So just take that into consideration, you know, but that's a big thing that we, you know, that a lot of people didn't really, and cost segregation has gotten more and more popular, you know, through, you know, some of the Jobs Act and some of the other things. And so it's between bonus, you know, depreciation, and a couple other things. So you're seeing that on a lot of sponsors' pitch decks. And for people that are in IRAs, that's not as big of a deal.
Absolutely.
So.
Money Mondays, every Monday, 3:30 p.m. If you guys have any questions, please feel free to drop it. Otherwise, we're going to wrap it up in about a minute.
Wrapping it up.
All right, Ben, can you count down from 60 seconds?
Well, no. Yeah, I can't count that long. Come on. Can't count that long, man.
All right, well then, if anyone has any questions, let's call it a wrap.
All right, going once.
Twice.
And 3. All right, folks, well, we appreciate you tuning in, and we'll see you next week.